This week will be a very important week, not only because today is Father's Day, which, happy Father's Day. I am a father of two, and a lot of dads do not get the credit that they deserve. But beyond that, the NASDAQ on Friday hit a new all-time high. We have a bunch of different things going on. We're coming off of the Fed meeting last week, a bunch of data, a weakening of our markets. Let's be honest, the average stock has done terrible since the Fed, but yet markets continue to hit all-time highs. This week could prove to be important. We do have some economic data like retail sales coming this week, and I will highlight why that is important. We also have some PMI data coming out on Friday. Not to mention Nvidia that did go through its stock split on Monday that you really haven't seen that post-split sell-off that you typically see. Worth mentioning though, Nvidia was down about 0.5% in after hours on Friday, really took it on the chin in the last hour or so of after hours on Friday. We'll see if that's the start of something a little bit larger. Do me a quick favor and hit that like button and subscribe to the channel if you have not done so already, and if you like the perspective or information provided every day here in these videos. So first things first, I think it's important to acknowledge this market is not a strong market. If you're in the S&P or the NASDAQ on a headline basis, you may think it is because the indexes continue to hit new highs, including on Friday, but it's actually very weak under the surface. It's kind of like a house that has termites. It's not as strong as you think it is. And you really don't know until you start to get inside the actual foundation just how bad it is. And let me tell you, the foundation of this market is pitiful. You can see this reflected in the percent of stocks above their 50-day moving average. If you're not above your 50-day moving average, that means you're doing pretty bad. Just for context, Tesla is down over 30% for this year, and Tesla is still 3% above its 50-day moving average. So currently, you only have 36.5% of stocks above their 50-day moving average. That's rough. Ever since about mid-May, you had 63% of stocks above their 50-day moving average. So that's down almost 50% just in a month. Even on Friday alone, as the NASDAQ hit a new all-time high, you actually had 6% of stocks, of all stocks, that fell under their 50-day moving average on Friday. So your average stock really is not doing well, and it hasn't done well for a long time. The reason for this real underperformance in recent days and weeks, including the Russell that was down about 1.6% Friday, down another 0.1% in after hours on Friday, is because of recession fears. Because of fears that the Fed is going to break something and be late to start cutting rates. If you are a bull in this market, you have to be under the logic or narrative that the Fed will engineer a soft landing. The Fed will cut rates before that non-farm payrolls report comes in negative, before that unemployment rate rises too much, because if not, you're going into a recession. Even Tom Lee on X says inflation will plummet throughout the rest of this year, and the Fed will start correctly easing. But a few months too late. Now, if you're a bull, a few months too late is not good. Now, I do think some areas of the markets are better priced for a recession or a Fed error, including small caps and mid cap stocks, and really your average stocks. The areas in which that are not priced for a Fed error or recession are your big tech names. Stocks like Nvidia, stocks like Microsoft that are deemed these huge AI winners, and maybe they will be in due time, but a lot of it's just a little too far. Like seriously, companies will stop ordering Nvidia GPUs in the quantities that they are if we are going into recession, because why? They don't need them for their products, right? The products that Microsoft is selling are minimal. Like virtually nothing to Microsoft's business. Do they need to continue to buy massive amounts of GPUs? Not really, especially if we go into recession, or it looks like we're going into recession, and Microsoft wants to prioritize their own EPS, their own, earnings, to maybe not sacrifice their stock for NVIDIA. Look at Tesla or Amazon that have recently said, hey, we have enough GPUs. We don't need any more for now. If that is a trend that starts, that could be problematic because NVIDIA is really the godfather of AI. If NVIDIA were to, for God forbid, have a bad quarter or bad guidance or maybe just not as good as expected, then that's going to lead really your big tech stocks to sell off big time. Now, NVIDIA does not report earnings for a couple of months, but Wall Street will start to price in, hey, maybe NVIDIA could start to do a little bit worse. And that could lead to a pre-earning sell-off, really any time now. Just statistically, most stocks in the last couple of years that go through stock splits tend to do well over time, but they do tend to have a post-stock split sell-off. And again, I just want to remind you, I am probably the biggest bull on AI that you know. I think the world will look something like the Jetsons in 50 years, and I think a vast majority of that will be NVIDIA powered, right? Powered by NVIDIA. But when you've rallied this far on NVIDIA in this certain sector of AI that's influenced the market so dramatically, just really because of one company that continues to put up good number after good number after good number, that is not sustainable. And it's especially not sustainable if the Fed is going to make an error that causes companies to become more conservative. One of the first areas they're going to slow down investments is in their GPUs, in their AI endeavors. Because let's be honest, after a year of this AI craze, Meta, Microsoft, Google, all of these guys either are making their own semiconductors anyways and just using NVIDIA to kind of top off their own capacity, or they have enough, right? Tesla has 50,000 H100s. How many more do they need right now? None. And I would argue that's probably the same situation that other companies are in. Also worth mentioning that semiconductors are typically pretty cyclical to the economy. If you go into a downturn or a recession, semiconductors tend to do bad. If you're in boom times, semiconductors tend to do well. If the Fed makes an error and we go into a bad time, I don't think NVIDIA is going to continue to save the day. But really, my recent defensive position on our markets, more conservative position, thinking there could be downside here, really doesn't come down to NVIDIA. I think NVIDIA would be like a disaster, right? NVIDIA would be like the last straw if they came out, let's say Monday, and lowered their guidance or something crazy like that. That would smack the markets in the face. But I think the Fed's the bigger issue here. Whether or not NVIDIA continues to put up solid numbers, recession or not, I don't think is going to save the markets. Again, as I said, the average stock is already doing bad. And it's really just a matter of time before you get that likely catch down where big tech falls to match what other stocks are doing, which other stocks, as you know, have been selling off. And I know this is not going to be a popular take. A vast majority of you guys and other individuals are super bullish. And long term, I think you don't want to bet against America. I think America's really one of the only investable, if not the only investable markets out there. But after the Fed has made it very clear they're waiting for something to break before cutting rates, and stocks are this extended with a leadership that is so narrow as it is only a matter of time before you go through at least, bare minimum, another correction. Just to kind of put this into context, from today's level on the NASDAQ, just to get back to where you just were in April, your April lows, you're looking at downside of 14%. Could you fall 20? I mean, that really would put you back to where you were in November of 2023. Right? That would put you back to about 384 on the triple Qs. I think we need to be open for some material downside here. Again, even just a drop 13, 14% is going to put you back to where you were 2 months ago. And I think people need to be prepared for that. JP Morgan came out recently and said, we really will have issues if the NASDAQ falls under its 50-day moving average. That's where you could be looking at a new retest of the lows that you've seen in April. We're still 7% off that level, but I mean, now is probably the time you want to be watching for that corrective downside. I mean, you are coming off of 5 green days in a row for the NASDAQ. If you look back to the prior 2 red days, they were 0.3% negative, 0.03% negative. So you were down 16 cents this day. And this day you were down 41 cents, about a tenth of 1%. Before that, you were up 2%. Then you were up a third of 1%. Then you were up a half of 1%. And then you were down 0.2%. You really haven't seen a down day for the NASDAQ in any kind of material fashion since, what, May 30th? If you take a look at the RSI on the NASDAQ, it's at 78.64. Anything above 70 is considered overbought, and the last time you were this overbought was back here around the end of December of 2023, and you actually did get a little bit of a sell-off heading into 2024 at that moment in time. You did fall about 4% or so. But again, that was when markets were expecting 6 or 7 rate cuts in 2024. Inflation had fallen like a rock, and it looked like the Fed was going to be cutting rates in March. Now it looks like the Fed's not going to be cutting rates maybe at all this year. It looks like the Fed is waiting for something to break in the U.S. economy to enter a recession or come damn close to one, while you also have most stocks in a decline, whereas that was much different in December. In December, you actually had 83% of stocks above their 50-day moving average. This is a much sicker, weaker market. And again, I do think people have gotten a little too conditioned to all rate cuts are good. Not all rate cuts are good. On average, the S&P falls over 20% upon the first Fed rate cut. That's typically because the Fed waits until something breaks to start cutting rates. The only way in which a rate cut will be good for our markets is if the Fed is cutting into strength. If the markets, the economy, are at a good point, right? There's no sign of a recession. That's when the Fed cutting rates will probably be good news. Fed's not waiting for that. The Fed is waiting for something to break, for unexpected weakness, a bad non-farm payroll report, a bad unemployment rate, a bad something. Maybe Nvidia misses earnings. That could cause the Fed to cut rates at this point. That's what the Fed's waiting for. That's not a good setup. Literally, it's only a matter of time before you do see a correction at the bare minimum or an outright crash, because at this point, a correction, 10% is going to put you back to where you were. It's like joke. It's laughable, right? It's going to set you back to where you were about May 1st. About a month and a half ago. And again, the problem is when the breadth is so bad in our markets, when your average stock has done so bad in recent days and weeks, and big tech's been leading, if big tech just gives up, then you can start to see some really big down days. And obviously, this is not guaranteed to happen. Who knows? Stocks could continue to run here. The top 10 stocks in our markets could continue to pave the way to new higher highs and new higher highs. But it's playing with fire here. And I hope this video maybe opens your perspective up for what could be coming next. Because this, on a risk to reward basis, to be long in our markets right now, in the near term, the next 3 months, does not look attractive. Like, how much upside is really left right now? Really? If the Fed is making it clear they're not going to cut rates until something breaks, until the economy goes into a recession, how long do we got left? Of course, I don't have that exact answer, but we do have data coming out this week that will be very important to answer that. For this week, starting off tomorrow, you will have New York Empire State Manufacturing Index, as well as Fed Harker that speaks at noon, and Fed Cook that speaks at 8 p.m. on Friday. Tuesday is probably going to be one of your bigger days for this week, when you get retail sales month over month. Last month was 0%. We're expecting 0.2%. So that's still not a strong number. But if you come in negative, then you can really start to get more recession fears going out there in our markets, which is kind of what Friday looked like anyways. Anything that was deemed risky or risk on sold off, and big tech just seen more concentration. Now, 8:15 in the morning on Tuesday as well, you will get industrial production month over month, expecting a number of 0.2%. Again, last month was 0%. Business inventories month over month expected to be positive 0.2%. Last month they were negative 0.1%. Fed Barkin will speak at 9 p.m. Fed Collins, Fed Kugler, Fed Logan will all speak from 9 o'clock in the morning until noon. You will get a 20-year bond auction, which will be important. Will move our markets at about noon as well. The last yield we had was 4.635%. Anything higher than that, it's likely going to be bad news. Anything lower than that's likely going to be good news. Fed Muslim speaks at 12:20 p.m. and Fed Goolsbee speaks at 1 p.m. on Tuesday. So a bunch of Fed speakers, which, I mean, let's see what they have to say about the last presser from Jerome Powell. Maybe Jerome Powell was just having a bad day and sounded more hawkish than what the Fed actually is. I have a feeling that's probably not the case, and they just want to see something break out there in the economy before cutting rates. And that's ultimately a very bad setup for stocks and would actually lead to a sell-off after the first Fed rate cut. But again, we'll wait and see. Maybe Fed speakers can alleviate some of those hawkish fears that we had from last week. The inflation rate comes out from the UK Wednesday at about 1 o'clock in the morning. And for your day Wednesday, you really don't have much. You have the NAHB housing market index expecting 48. Last month was 45, so a little bit of an improvement there is expected, but nothing too crazy at all. Thursday, Bank of England interest rate decision. You're expecting they are not going to do anything, just stay paused. If they cut, obviously that would be not forecasted, unforeseen, and that might catch even our markets by a little bit of surprise. Building permits will come out Thursday, 8:30 in the morning. Initial jobless claims, Philadelphia Fed Manufacturing Index, Philly Fed Business Conditions, Philly Fed CapEx Index, Philly Fed Employment, Philly Fed New Orders, and Philly Fed Prices Paid. Prices paid, specifically that component, will be very important. And overall, any data that we get right now that suggests the economy is strong, the economy is weak, will be taken as big, right? And that Philly Fed data can be very important because it really incorporates that entire area, which is like New York, which is other areas as well that have implications in those specific data releases. Now, Friday, we will get S&P Global Composite PMI Flash, S&P Global Manufacturing PMI, and S&P Global Services PMI. This data will actually be very important. It comes out at 9:45 in the morning on Friday. Existing home sales for the month of May and existing home sales month over month will also be coming out at about 9 o'clock in the morning on Friday. Actually, about 10 o'clock in the morning on Friday, we will get that. We actually do get some earnings this week as well. A big theme of this week will be the home builders with Lennar and KB Homes. Lennar reports Monday and after hours. KB Home is Tuesday and after hours. And then you have Steelcase Wednesday on Thursday. You have Aora, you have Accenture, Kroger, Darden Restaurants, and a couple other names as well. Thursday and after hours, Smith & Wesson, and that's it. And then Friday, you have CarMax and FactSet. So some of these data points like retail sales and that data that comes out on Friday, the S&P Global PMI data, will be very important to just see how strong the markets, the economy really is. If retail sales were to come in negative, then investors may start to ask more questions about a recession. And judging off of the risk off day that you had on Friday, the Russell down 1.6%, the VIX up 6%, the S&P down marginally, the Dow down marginally, and the Nasdaq slightly in the green. That 6% rise in the VIX, the 1.6% fall in the Russell 2000, and the fact that bonds were actually down about 2 basis points shows you, hey, there's a lot of fear and concern of a Fed error in our markets right now. And again, the markets like to price everything in ahead of time. So if the data starts to look even worse, then the markets are going to start maybe pricing in a recession or recession risk in our markets. And it's actually very weird because in the bottom 95% of the markets, recession is probably priced in with a 30-40% probability. Right? That's what stocks are discounted for. If you look at the top 5% of the markets that has the market weighting in the Nasdaq or the S&P, like your big tech, Nvidia, Microsoft, Google, Amazon, so on and so forth, the stocks at all-time highs right now, there's a 0% chance of a recession priced in. So there's really a disparity between investors believing, hey, there's a 30-40% chance of a recession over here and a 0% chance over here. That's not how things work. And you've seen that in 2022. Like, there's historical precedence on this. Everything did bad in 2022. Recession-sensitive areas did worse, but big tech also did poorly. Very poorly. To sit here and think it's right or it's accurate to price 30-40% chance of a recession in small caps and mid caps, but 0% in big tech, the day of reckoning will come where big tech needs to start pricing in a 30-40% chance of a recession along the lines of what small caps and mid caps are already pricing in. Like, if small caps and mid caps were sitting at highs right now or anything close to that, this would be a much different video. But there is two different tales of this market. And unfortunately, that's not how things work. And given the run that we have seen in markets as of lately, it's time to be defensive. In fact, this is like laughable, right? Take a look at CNN's Fear and Greed Index. You are sitting at 38, which is fear. And the Nasdaq's at all-time highs. That is just unhealthy to a large degree. When have you ever seen CNN's Fear and Greed Index in fear and the Nasdaq roaring to new all-time highs? I can't recall a moment in time that has ever happened. Like, look at the disparities even between the 7 indicators of the Fear and Greed Index, Fear and Greed indicator. You can see market momentum, extreme greed; stock price strength, extreme fear; stock price breadth, extreme fear; put and call options, extreme greed; market volatility is neutral; safe haven demand, extreme greed; junk bond demand, extreme greed. When you take a look at the S&P 500 option activity for this upcoming Friday's expiration, you have calls open interest of about 30% and put open interest of 70%. So that means there's 2.3x times more puts than calls for this upcoming expiration. That's a pretty dang hawkish or bearish ratio, which could be a sign of maybe a reset could be coming this week. I don't like to make ultra short-term predictions, so I wouldn't be surprised if stocks do little to nothing this week, but I also wouldn't be surprised if this week's a 5% down week as well, because I do think when that correction comes, when the markets realize, oh crap, big tech's not safe, AI is not safe, maybe there is a chance of a recession in these sectors as well, then I think you will get a sharp downside move, something you have not seen in probably many years. The markets are just so top heavy right now that you could have the bottom 98% of the markets actually do well on any given day, but the top 5% do very bad, and it would still equal a very bad day for the Nasdaq and the S&P. And I gotta say, I've started to raise some cash here. I do have some defensive positioning in my portfolio. I'm not selling everything. I'm not selling my long-term stocks, but anything that I was kind of swing trading, biotechs, other stocks that I don't want to hold for the long term, which is like 5-10% of my portfolio, I did sell those. I do want to have some cash on the sidelines to take advantage of this downside I know is coming. When it comes, couldn't tell you that, but I'll tell you. It's coming. Of course, I am not a financial advisor, so let me know what you think down below in the comment section. But I mean, if Nvidia does give up, right? If Nvidia were to lower their guidance or come in bad on a quarter of earnings, or maybe recession fears just become more obvious, I find it logical that stocks could at least go back to November of 2023 lows, which would put you at about 29% downside in the Nasdaq. Again, I find that logical. Not necessarily a base case assumption, but could you erase the 2024 gains? Of course. The Fed making an error usually gives you over 20% downside in the S&P 500 when the Fed cuts rates because of a recession, which is the path that we're on. That would put you at about 380 on the Nasdaq, which would literally eliminate all of 2024 gains. So let me know what you think about this information down below in the comment section. I know I'm going out there. I'm going out on a limb. I know a lot of people are bullish right now, and that's exactly why I feel the need to make a video like this one, just putting it all out there for you. If you appreciate that, whether you agree or not, I hope everyone doesn't agree. I hope everyone, doesn't disagree at the same time, right? You got to be open for different things that challenge your beliefs. So especially if you're a bull right now and you're listening to my voice, you made it to the end of this video, I want to say congratulations, right? Because a lot of people that are just perma one way won't even listen to an argument that is contrary to their own. And that's where people get in a lot of trouble. That's where people are over positioned and over leveraged for one move and get blown up when that does not happen. And again, I want to make it very clear. I am bullish long term. I am bullish for 2025. I think either way, if we get a bunch of rate cuts this year because the economy goes to crap, or we get a bunch of rate cuts next year, either the beginning of next year is going to start off good if that happens in 2024, or the second half of 2025 is going to be good because rates are going to be lower. Usually markets panic more than what is necessary when the Fed cuts rates because of a recession fears overall. So I do think we'll probably overshoot at some point to the downside, and then markets will wake up one day and say, hey, rates are super low. Maybe earnings will hold up. Maybe the recession is not going to be as bad as we think. And that's where the bottoming process will then start. When that happens, how severe that is, I couldn't tell you. But what I do know is if big tech comes down to any degree that small caps or mid caps have already done, you're looking at severe downside from here. And I think that's the biggest risk we need to be watching out for. So hit that like button and subscribe to the channel. You guys have a fantastic rest of your day, and I will see you in the next one.